For years now, one of the easiest trades in commodities has been to buy whatever China doesn't have. But the Chinese government's effort to slow the economy there may wreak havoc on positions that once turned easy profits. Here to sort out the smart bets from the dumb ones is Adam Sieminski, the chief energy economist for Deutsche Bank. He's in Washington today. Adam, you've looked at what the Chinese government is doing to the economy. How is it going to affect commodities?
Well, the main thing that China's trying to do is to slow things down a bit. They believe that they've got a bank credit problem, a bit of a property bubble problem, and they've been stimulating their economy just like we have in the United States. So over in Beijing, they'd like to just slow things down a bit, not create a big problem, but maybe a plateau mid-year.
All right, so when we look at individual commodities, where are we likely to see the greatest impact?
Well, one of the things that our metals people have looked at is copper. There was a big accumulation of copper inventories last year that was helping to support prices. That was continuing even early this year. Our view is that that could reverse and that we might see better opportunities in something like aluminum rather than copper. On the oil side, underlying fundamentals are getting better, but they're still a bit weak. And we think that if both the U.S. economy and the Chinese economy slow a little in the middle of the year into the second half, that should negatively impact prices in those areas.
All right, Adam, I want to talk about copper a bit more and then go back to a little more on oil. A lot of people think that the disruption in the supply chain in Chile, if not at the mines themselves, then in the roads and the railroads that carry copper concentrates and cathodes to port, is going to make for a bullish trade in copper. I get the feeling that you think what's going on in China is far more important as far as demand goes than whatever supply disruptions may happen in Chile. Is that correct?
That's basically correct. We think that in Chile that the infrastructure there is being weaved back together much more quickly than we've seen in Haiti. The Chilean government was much better prepared to be able to deal with these things, and we think there'll be workarounds that'll happen a lot quicker. The demand side is going to be a bit more difficult, we think, on copper.
Now, you mentioned the U.S. economy when you were talking about oil. I was frankly surprised, because I haven't looked at your forecasts for some time, that you've got a $60 target for oil by the fourth quarter of this year. What is it that you see and your colleagues at Deutsche Bank see out there that makes for such a bearish environment for oil in the next, say, 6 to 9 months?
Right. Well, you know, you have to put all these things in context. Back when oil was under $40 earlier in 2009, that forecast looked fairly bullish, actually. What we're thinking in terms of why the second half of the year could be weak is that inventories are still high, demand is still relatively weak, there's plenty of supply, lots of OPEC spare capacity. All of the things that typically were pushing prices up in 2007 and 2008 are really missing. There's a lot of spare refining capacity as well, and that should help to temper prices. The $60 forecast is more in line with what we think the underlying fundamentals would be at that time. As we move out into 2011 and 12, we believe that things will begin to tighten up again, and we've actually got an $80 forecast for 2011. It's just that second half of this year that we're a bit worried about.
All right, Adam, one more thing. We've got about a minute left. Your projection for gold going on to 2013, $800 an ounce. That's a contrarian view, and it certainly contradicts people like David Einhorn, other hedge fund managers who are very much long gold right now.
Well, one of the things that we've been looking at is the relationship between the U.S. dollar and how it trades against the euro and the prices of both oil and gold. Our FX people, foreign exchange people, Deutsche Bank, believe that the dollar will strengthen. If this year they were thinking that we could see price down to 130 to the euro, we're probably closer to the bottom in the dollar than the highs. That means that over the next few years, a stronger dollar as the Fed raises interest rates should be contributing to a little bit of weakness in both gold and oil prices.